funds, which then make your loan more risky. So because your loan's being qualified in this case, right, on 3 rental incomes plus your individual income, you have a certain factor for risk, okay? So think of it as, I always compare mortgage rates to driving records for insurances, right? So when you go for your auto insurance, they pull your driver abstract and they tell you, okay, well, how many accidents do you have? How many points do you have? How many tickets do you have? What violations do you have? Unfortunately, everything is based off of statistics of risk. So somebody who buys a 4-family home, I'm giving an example, I don't know what the actual number is 85% more likely to default than buying a 1-family home. Well, why? Because they're qualifying you based on a hypothetical ability to collect rent and be a landlord, right? And even though your income's taken into consideration, you might be able to qualify just on your income on this $1 million property. They still build in these buffers. Think of it as a premium. So because you're more likely to default on a 4-family, banks want you to put more of a down payment in order to offset the likeliness to default so you have more skin in the game. So what's the number one way to beat the bank? And one thing we're gonna get into always, even though we work for the bank, is a concept called beat the bank. Because even though we work for the bank, we really work for the consumer, right? We are here to educate the consumer and help you get the best rate because we get paid a salary. We want to help you afford your home, right? We want to be your guys' advisors. So when we help you beat the bank, we tell you, here, circumvent all this crap and put in $250,000 down, buy this 4-family and put $35,000 out of pocket, right? Now listen, your mortgage payment, again, I don't know what the actual number can come out to. Let's just say your total mortgage payment is now $7,000 a month, right? Depending on where your property is. Hopefully, these 3 rental incomes can pay $7,000. So that comes out to give or take $2,300 each, right, per unit. Now all of a sudden you're living rent-free. Rent-free. Nothing. You're living totally free. And after the tax benefit, because there's a tax implication as well, you might even get an additional IRS tax federal refund of $10,000. Now, what people don't take into account, and I don't know why they don't do this, probably because they don't want to accept this, every time you make your mortgage payment, which remember you're not making because your tenants are essentially paying your mortgage, this, let's just call it $965,000 loan, is decreasing. And again, based on the market that we're currently in, this strictly goes to an appreciating market, this value is now going up. So you're not paying your debt off, you're collecting the rents, your tenants are paying your debt off, and the market, based on current conditions, are going up, right? So people are like, wow, I got in with $35,000, and every year I'm getting $10,000 more. Well, if you do your numbers of return on investment, think about it. That's a 30% return on. You lay out $35,000 to get 10. In 3.5 years, you're getting all your money back. Where else are you going to see a 30+% return to market on your cash investment? Plus, whatever this variable is. This is like the unknown. No one knows what this number is right here because the market dictates that, right? So now you're getting somebody else to pay off a loan that you took out. Every single day, your net worth is growing, and you're still, even if the market does drop, you're still getting $10,000 every year. So what's the best investment to make? A multifamily, right? So banks look at 2 and 4 families as risk, again, because they're qualifying you based on proposed rental income, even though it's really not risky. But people always make the first step of, oh, I want to buy a condo first, I want to buy a 1-family house first. That's great. If you do that, you eliminate this option of buying a multifamily with this. So now, okay, you want to buy your next property as an investment, well, good luck, you got to come up with these types of numbers here that are 6 figures in multiples. So you have to really weigh out your options on what your goal is of buying real estate. That's why I tell everyone, listen, if you're worried about debt, if you have a small salary, 50 to 60,000, the best way to get active in the real estate market as a real estate investor and still have your full-time job is buying a multifamily home. And without doing that, you're obviously going to jam yourself up if and you ever want to buy a home in the future as an investment. But again, people all have to take on the risk themselves. Our job is to just educate you on where we see the market heading and then telling you, again, how to beat the bank. If we can